Well, hello everyone. Welcome to Covered Calls and Short Puts. My name is Barbara Armstrong. I have the pleasure of filling in for Mr. Cameron May today. And today we are going to talk about buy right covered calls and covered calls. And what's the difference between a covered call and a buy right covered call? You might ask, well, that's what we're going to talk about today. I also filled in for Cameron May last week. And we placed some trades last week, so we're going to follow up on those, and then we're going to place some new example trades. So I'm delighted that you guys are all with me. I see a lot of the usual suspects tuning in. Some great questions have already been asked. So hello to Will and Mark and Josh and Kevin and Robert and Tony and Lori and Eva, who I think has left because she's got workers creating a racket, and Marcus and the rest of the gang. Thank you all for being here. Cameron will be back next week. So if you need a little Cameron, he will be back next week. I invite you to follow us on X. I have Ben Watson with us in the chat today, and Ben, I just full disclosure, Ben does not have a Canadian keyboard. So if I use some Canadian expressions, he may be limited in his ability to respond. But generally, when it comes to these trading strategies, he is a font of wisdom, and I love getting to work with Ben. So you're going to want to follow him on X. His handle is at Ben Watson CS, mine at Barb Armstrong CS. I'm also now on LinkedIn, as is Ben, so you can wander over to LinkedIn and find us there as well. And obviously, Ben and I, like teasing one another. But if you've not had the chance to meet us in person, just know that we are on the road. I think Ben will be at 23 of the 24 events that we are hosting in person this year. The only one he's missing is this next market drive. But Kevin Horner and I will be there. There will be network personalities there. Joe Mazzola, who's a frequent contributor on the network, will be there. We'll have the coffee on. And if you've never been to a market drive, it's not too late to register. We start with, here's, where we are, globally with the markets. Here are things that are impacting, like the Strait of Hormuz, tariff discussion, what's happening here within our own borders. We're looking at sector strength, market overall, and right down to individual stocks. So that is May 16th. We've got an event coming in after that in Santa Clara. Registration is now closed. You can show up the day of and register, and we'll do our best to find you a spot. And then we've got two-day events, and I'll be at these next three: Santa Clara, San Diego, and Chicago. And this is a 2-day event. First day's intro to technical analysis, and then intro to options. That will be repeated in Chicago. So lots of great stuff coming up. They're free to attend, but they're very popular. So I encourage you to register quickly so that you don't get shut out like Santa Clara. Okay. So, and somehow, I guess I put my important information in the wrong spot, but know that options carry a high level of risk and aren't suitable for all investors. And there is an options component to both buy right covered calls and covered calls. We are using the software, the Thinkorswim paper money software application on the Thinkorswim desktop platform. One of the differences, though, with paper money as opposed to a live account is that short options will never be assigned prior to expiration in paper money. That can happen in a live account. And while that's not always a bad thing, it is a thing, and we need to be aware of the difference, okay? Also know that stop loss orders don't guarantee that we're going to get out necessarily at the price that we have requested. So that's important to take into consideration as well. Okay, so our S&P 500 hit a new all-time high on Friday, pulling back a little bit today. NASDAQ hit a new intraday high today, a new all-time high Friday. The Russell hit a new intraday high today. So it's pretty hard to characterize the market as anything other than bullish when you have so many of the indices, at or within a stone's throw of their all-time highs. And I'd characterize the Dow as, kind of this big bull flag, with a bull flag and a stiff breeze. But it's up in the neighborhood at 490. It's not far from the all-time highs established back here in February. Now, what we are seeing on the VIX today is that there's been a bit of a pop, but even at that, it's sitting at 18, still under 20, a long way from the 30-ish range that we were seeing a few weeks ago. But the nice thing about seeing a little bit of a pop is that when volatility goes up, option prices tend to go up. Okay, so when option prices go up, that means the calls we're selling, we might get more money for. And so that can be, not such a bad thing. Okay, so I want to start by answering a question that was posed by Josh in the chat and looking at one of the trades we placed last week, and that was Cisco. So let's start with Cisco. So Cisco, well, actually, this one we placed on April 16th. So this one was placed a couple of weeks ago. And we basically treated it like a swing trade because here was the previous high. We had a diagonal resistance breakout, and we said, hey, if this could come up to this previous high around this 87.50 mark, we'd be willing to sell it. And now it's at 92.84 and it expires May 15th. So if this were in a live account, we could be called out. Like, it doesn't matter how far it's in the money, or even if it's in the money, we could be called out at any time. So if you are selling a call on a stock and under no circumstances would you ever want to part with it, then you shouldn't be selling a covered call because that is a risk. But when we look at this and we say, okay, so this is in the money. If I do nothing and it's still above 87.50, I'll be called out. Now, when we placed this trade, we ran the numbers, and the goal was actually to be called out. And we said, hey, the most we can make on this is 87.50. We paid 81.81 to get in. Okay, so if we paid 81.81, how much could we possibly make? Well, if we just take this 87.50 and we subtract 81.81, then the most we could make on this is $5.69 a share. And so we did 3 contracts, so we'd have to multiply that by 300. So then the most we can make on this is $1,707. And how much have we made? Well, we've made $12.84. Now, when I did this, half an hour ago, it was $13.03. But at $12.84, that's still over 70%. So if I take $12.84 and I divide that by 1707, which is the most we can make, we have made 75% of our max gain. So one of our choices here, when we have 11 days to expiration, is like, cue Steve Miller, let's take the money and run. So that's one choice. Now, Josh, his question was, if I've sold a covered call and it's in the money, what should I do? And, that's a personal question. It depends on what your trading plan is. And, some people might say, hey, you know what? I've got 75% of my max gain. I look at the chart. It looks like it might keep going up, but it could pull back, and never say, like, there's no way this is going to, end up in trouble. We have earnings come May 13th, which is before this expires. And look what happened the last time on the last earnings. Now, the earnings before that, it gapped up. But what I'm trying to point out is that this stock, it's a gappa, it can gap on earnings. And so our plan was to be out prior to earnings one way or the other. And seeing as next week's Cameron is back and we don't have a chance to discuss this again next week. So, we can get out, like, and like Clint is saying, no one ever loses by taking profits. True enough. Now, if this were assigned, we'd have our max gain. Like, we'd be thrilled to be called out on this. because then we'd have our max gain and we wouldn't have to, muddle through this decision. But another choice we might have, we could roll it out to June maybe, and maybe roll it out and up if we could get a credit. And then you might say, but with my buy right covered call example trading plan, I don't want to trade this over earnings, and we'd be trading this over earnings. And you might say, well, earnings is the 13th, so it would give me enough time, to kind of recover. And so if we come to our monitor tab and we just want to see for giggles, we could say, well, create a rolling order. And what it will do, we're essentially buying this back and selling the next one out. But if we came out and we said, we want to come out to the June monthlies and we want to try and come up to say 90, well, we'd have to pay 25 cents for that. And so if we're saying, well, we want to stick to our trading plan, I'm just going to take the money and run. Okay, so on this one, we're going to take the money and run. And so how do we do that? Well, we have an exit in place, a stop loss order. So we're going to come in. I've organized these alphabetically. We're going to come to Cisco and say, we would like to cancel that order. And so you'll see that order for Cisco is now gone. And then we're going to come in and we're going to create a closing order to just buy it back and take the profit that we have. Okay, so confirm and send. Yeah, so Dan is saying, and I was, going to have you guys vote on this because this one, we could go either way. Now, the other one that we did was buy right covered call. Oh, Google. So Google, how come there's no like chiclet here with an exit? And that's because we did this trade last week and we broke our rule. And what's our rule? Is that we don't trade this over earnings, because if it gaps up, we could be called out and we'd be okay with that. But if it gaps down, the covered call only gives us so much protection. And in this case, it was $8.25 worth of protection. And what we did on this one was we bought a protective put. So we said we're going to take some of the money that we get from selling the call and we're going to buy a protective put with the goal of that put expiring worthless. And so, we bought the put, it gapped up, so yay us. But here's our strike, was at 365. Now it's at 387. And so could we roll this out to June and, make a little more? Well, we could look at that. So we could look at rolling this. And this has gone from 825 to 2180. But if we look at this again, like if we look at our original numbers, remember our goal on this was to be called out. And we said, well, the most we can make on this is to exit the trade at 365. We got in for 344.57. So if I subtract one from the other, the most we could make on this was $20.43 a share times 100. So it's 20.43. And where are we? We're at on the Google trade, we're at 1798. Like call it 1800, but 1798. The market must have pulled back a little bit. So so if I take 1798 and I divide that by 2043, that's 88%. So we've already made 88% of our max gain. And so again, like you can't never say like there's no chance this is never coming back, but this is so far in the money. It's $20 in the money. So what are the probabilities that we could roll it out and not have to pay a debit? And the other question when it comes to rolling that some traders will ask themselves, they'll say self would I place this trade now? So it's trading at 384. Would I place a trade selling a call at 385? Yeah, so it's Dan is right. Like, do we close this out now or do we roll it? And so if we come to our monitor tab and say, well, could we roll it out to 385? Create a rolling order. And again, it will just pick the same strike. Well, we don't want the same strike. We'd like to come out to around the current price. And we're going to come out to the June monthly. Oh, this has a lot of strikes. So that would cost us $4.10. And so, you know, we might just say, you know what, this was a nice trade. We did it over earnings. You know, if it's, I think we were joking about like Paris for Christmas or take the kids to Disney or buy your new car fund, whatever it is, like we're adding a nice little chunk to the kitty. Maybe we just ring the bell and take the money and run. And so if we say, okay, that sounds like a plan. So we're going to create a closing order to sell this and to exit this position, confirm and send. And, you know, when we come and we look at this Google trade, although I said, you know, we've made, you know, 1,700 and whatever amount of money, we did sell this put. And so $233 went to buy that short-term coverage that it turned out we didn't need. So we'd have to take that off our profit. Okay, but we've got both of these orders now percolating. The one on Cisco, so it's saying, oh, we only want to pay you 8608. So if you see something isn't getting filled, we can cancel and replace that and say, you know what, if you give us 86, like we're feeling generous today. So we'll put that in our buy right because we are live in the market. So we got out at 86. We still had a nice profit on that. And on Google, 362.92, they're saying, oh, we want to give you 7 cents less. You know what? Go nuts. Yeah. Okay, so that's those. Now, I want to compare and contrast a covered call because I happen to have shares of this stock in this example trading account and placing a new call. So when we look at, if you look at the example trading plan, and I'll show you where to find one, but if we have something like Intel, like, wow, this thing was going like a whole lot of nowhere. And then it just took off, right? It broke out and kept on going. Then we hit earnings and it gapped up, you know, came back and kissed this as a support level. But today we have this bearish Harami pattern happening. And some people might say, well, if you own the stock, this might be a good time to sell a covered call. You know, this might be a good time to sell a covered call because maybe it pulls back for a few days and then you can buy the call back for less. And it's just a way to make some money as it's pulling back. Now, when we look at this stock, since it broke out on April 7th, 1 day pullback, like kind of 4 or 5 days consolidating, you know, then it gapped up, 1 day pullback, 1 day pullback. It may not be much of a pullback. But if you're saying, you know, I would be okay with selling this if it went up to say 105. Now, if you don't want to sell it because it's in an account that might trigger a taxable event and you're up a lot, like in this particular one, when we look at Intel, 400 shares, you know, we're up 128%, which is not too shabby given this account is reset in January every year. So we're up 21,000 on this. and we've given back 1,000 in profit today, but could we come out and sell? It's at 96. Like, could we sell the 105 and just for a short time frame? And again, our example, it's traded 89 million shares today. If we went out to the May monthlies and we looked at the 105, saying, well, our probability of it being above 105 is 26%. We've got like almost 10,000 contracts here between the contracts placed today and the open interest when the market opened this morning. A 55% chance it'll touch it. But if we're concerned that what goes up might come down and we could do a 2-week trade, if we're called out, we're up how much? Well, we're up another, call that 97. So we're up another $6 a share on a stock that's only trading at 96. Do you see what I mean? So if we just said, okay, we could sell how many shares? Well, we have how many contracts? If we look at Intel, we have 400 shares. So we could do 4 contracts. And if we're called out, well, we can either roll it. If it's in the money, we could be called out at any time. But, we're up, $8 if we sell the 105 plus the amount that we're getting for the covered call. So this is one choice that we might have, is to say, let's just sell these calls on stocks that on this stock that we already own. So we're selling. Now this is going to say that we have an infinite max loss. That would be the case if we were selling a naked call. But we are not selling a naked call. We are selling a call on a stock that we already own. But the most we can get is $1,000. And if it goes up above 105, then, if it goes, more than $2.68 above, we would have had a more profitable trade had we not sold the covered call. So we're going to put this in our covered call group and send it. Okay, now why would we consider, okay, now when we come to our covered call group, because we had this Intel in our growth stocks, so I'm going to click on this position and move it over to the covered call group, okay? But let's say we don't have Intel in our portfolio. Might we consider buying shares at 97 in recognition that it might pull back, but that we get paid that 269 if it does pull back and we're not called out? I'm not saying your accountant would look at it this way, but that you might consider it to be, $2.69 or whatever we get for that call off the purchase price. And we could, if we're called out, have we made enough for it to be worth our while? And if you're saying, well, if it pulls back, like I could see it could pull back like all the way here to 80. And if I want to play the long game, I might put my stop on this below 80. And you might say, like, is she new? Like that's a big loss, but we're going to position size accordingly. And what's accordingly? Well, we don't want to risk more than half of 1% of our account value. So if we say, well, that would be 52.44 it would be 1%. So I'm going to divide that by 2. I don't want to risk more than about $2,600 on any one trade. And so if I say, okay, I'm going to take this 80, I'm going to put my stop, 2% below that. Whoops. 80 times 0.98. This is for Intel. So I'm going to put my stop at 78.40. So let's come out to the trade tab and just look at if this makes sense and say, okay, if I want to do a buy covered stock at 105, it's going to cost me 94.20, and the most I can make on this is 105. So like if you're math averse, and it is Monday, so the most we can make on this is $1,000, and our max loss before we put our stop in is 94.18. So if I look at that and say, well, if I could make $1,000 on a $94.18 investment, that's an 11% return in 11 days. Like, that's not too shabby. Now, on the other hand, we could end up losing. And if we're paying 93 to get in and our stop is at 78.40, so 93.91 minus 78.40, that's 15.51 we're risking. And so if we do 200 shares, we're risking about 3,000. And that's if we get stopped out at the price we're requesting. So we really, and I'm not proposing a protective put. Like, we could use a protective put, and we could put it down here. But, if you're saying, I don't see the probability of it coming down to 78 as being that high, and what is the probability? So let's look at it. So I'm going to go to 40 strikes here and say, okay, at 88, our delta is 23. It's saying you've got a 78. Our delta is 7. The probability of it being in the money is 9.3%. The probability of getting stopped out, because if it even comes and kisses it, we'd be stopped out. It's about 18 to 20%. Now, if we wanted, we could buy a protective put here. The advantage of a protective put is that if it comes down and kisses it, we're not automatically out of the trade. We have the right to exercise the put. So we might, we could do that. We could do a protective put instead, that if it were to gap down. But if you're saying, I think these probabilities are such that I'm okay with putting a stop in here. We'd use the stop and not spend the 47 to 51 cents to buy the put. So we're going to right click, we're looking to buy covered stock, which is what we call this. We're going to do 2 contracts. And the reason we're doing 2 contracts is because of where our stop is. So if it does pull back and this expires and we add a new covered call, could we do more contracts? Perhaps, because this is 18,000. We're willing to have a position up to 25,000. So, that's a possibility. But for this one, this is where we are. We're creating an opposite order. We're making a market order because we're both going to buy back the call and sell the stock. We're going to say if Intel goes at or below 78.40, we'd like to exit. Does this make sense? So protective puts are a strategy that some traders will use more over earnings when they don't want to risk getting nicked out on a wick on a stop loss order and then have the stock rebound by the end of the day. That's when, like, that really frosts your petunias when that happens. So we're buying 200 shares of Intel. We're selling 2 calls, the 105 call. This expires in 11 days. Okay. And if Intel falls below 78.40, we want out. Our max profit on this, 2,160. We're going to put that in our buy right covered call group. And this is selling closer to resistance, where some people might say, I'd rather buy the stock when it's bouncing off the support. So some people might prefer to leg into one of these trades with a covered call. So they might say, Well, I want to look at a stock like, well, what's Starbucks doing? We could look at Starbucks. It has recently broken out, but let's look at TSM. So when we look at TSM, and this is part one, right? Like we're looking at the charts. And the chart is saying, hey, this thing is up 31% year to date. If we look at a 1-year chart and then change this, click on this icon and go show price as a percentage, it's up 126% in the last year. So, it's hard to characterize this like the market as anything other than bullish, way outperforming the market. It just recently came down and kissed that 10-day moving average, which of late appears to be acting as a support level. And so, could we buy shares? Now, what's the problem and sell a covered call? And just to finish the analysis, if we come out and we look at this, like, it's up 53% earnings per share year over year. And just because it's up, this dramatically doesn't mean every year is going to be like this. They could end up losing money this year, but up 35% in their dividend payment, sales are up. But the problem with this is for this account, a $40,000 position size is a little big. So unless we're getting, like a $10 on this, but if we came in and said, if we sold the $3.99 and we put in a target around $4.15, what would we get? And, if we come out to June, we're going to get more. So our choices are, we could do the 400, we're at 399. We could do the 410 or the 420. So the probability of being called out is lower with the 420. We're going to make a little less, but but if we get called out, we're being paid like $3 less, 16, $4 less, but we could make $10 more. And would that get us close to that? We're buying covered stock to that 30,000 mark. That we're still at 38,000. And so, great idea, but it's a little too rich for our pockets. So, if you're looking at this as a trader and saying, but I like this trend, I like the fundamentals, et cetera, et cetera, et cetera, could you just buy stock and put a target on it and buy fewer shares? And say, well, I could buy $25,000 worth, but I can't sell a covered call on it. Yeah, you could do that. But this is a covered call class. So we're going to, I always like to throw in a few, that, we're going to eliminate for one reason or another. But, when we look at it, our bid-ask spread, like this has 20,000 contracts on it. So like we could break that rule, because it meets all our other guidelines, just for the sake, like I've got 177,000 sitting in this account. But if you had a $500,000 account and you said, I don't want more than 5% in any one position. Now, if you said, I'm okay with 10% in any one position, then you'd be a go. And where might you put a stop? Well, you might say, you know what? I see support as being, around here, perhaps like old resistance, new support. Or you could say this 10-day moving average has been acting as support. But if we went with 387.64 times 0.97, if we said 3% below, our stop on that would be at 376. And so it just depends on what your guidelines are. Single order to put in our exit, right click, opposite order. We're making this a market order because if we're stopped out, we don't know what the price of the call that we sold will be. We just know it'll be worth less if TSM goes down to 376. Now for this one, we're going out to June. Now we might leave our stop in the same place if we went out to May. So what's the advantage of going out to June is that we're going to receive a higher premium, $16, but we're in that trade for 45 days and time decay. So let's just change this to our Greeks. And when we look at time decay, so we're receiving less. Oh, sorry, let me come to May. We're doing the 420 strike. Let's change this. So here, this 420 strike, we're looking at $5 and our time decay is 50 cents a day, like almost 10%. But we're receiving a lot less money. So if we are bullish on this, we might do this as a shorter term trade because we're getting 50 cents a day of time decay. Here, we're getting 28 cents of time decay on a $16 option. So it's a fraction, and time decay really works in our favor when we're selling. And so, if this were a less expensive stock, we might do two trades so we could compare and contrast them. But we're going to go for the longer duration here, but knowing that we're likely tying this money up for that we are tying this amount of money up for a longer period of time. Okay. So, and somebody's saying, how do you choose your stocks? And like it could be, could it be a stock that's consolidating or a stock that's uptrending? And the answer is it could be both. Like, so let's say if we look at ROP, so let's go ahead and put this one in. Okay, so ROP was something that we looked at in our class earlier today in trading a smaller account. But and this stock, the options, the bid-ask spread is too high. But if we're looking at something if you own this stock, and one would think that if you had a trading plan and you owned shares, you might have exited prior to this. But let's say you saw this uptrend and decided to get in and it started going sideways. What some traders will do with a stock, if they have it in their portfolio that's been going sideways, or maybe to use a better example, because if you had NVIDIA. So this was really uptrending. And then in September of last year, through really the end of April, it started trading in this range. And so then what some people might have done had they owned this stock is said, well, when it came up to here the first time and then came down and bounced, when it rolled back over, sell a covered call here, close it out when it bounces off the support level, and sell a call, sell the next one when it comes up close to resistance, buy it back when it comes back down. Sell it here, buy it back here. And if you'd sold it here, and if you were selling, say, the 205, if you were selling the 215, you might have been okay, but you might have had to roll it, or you may have been called out. So there's always, that chance. So it really just depends. So it could be a stock like a NVIDIA that's been consolidating, or it could be something that's uptrending or that's breaking out after a period of consolidation, like Starbucks, which we looked at briefly, where, it was on the struggle bus and then it started to come back around, kind of a bit of a sloppy and this is where there's some art and technical analysis, but a bit of an inverted head and shoulders pattern here, and then it's broken out. And you're saying, well, if I see this as being kind of at a new resistance level, if I buy stock and sell the covered call here, even if it comes back, I now own the stock. I could buy back the call when it bounces, maybe for a 30 to a 50% gain. And then when it comes back up here or if it comes back up and then pulls back, then sell another covered call here. Yeah, hindsight, like Leifo Lama is saying, like, hindsight's always 2020. But you just, with these buy rights, we're trying to set them up in the middle of the road with the goal of being called out, because we're looking to either grow the account with trades that we close out on a short-term basis, or we're looking to generate income. So, and I think I talked about it maybe in the last class. I met someone in Chicago a year or so ago at a live event, and I said, are you getting what you want out of this? And he said, well, really, I'm not. And we had this conversation. I said, well, what are you looking to do? And he said, I want to make $100,000 a year in income. And I said, is there a strategy you like? And he said, buy right covered calls, but I can't protect myself to the downside. So he didn't know how to put in an exit. And I said, well, 100,000 a year, it's basically 2,000 a week. And so here's, like, let's look at a couple of example trades, and here's how you'd put them in, and here's how you can protect yourself to the downside. So that's kind of another one of the benefits of going to a live event. For me, I get to talk to clients and see what they're thinking. But, for you as a client, you can talk to coaches and you get to have these one-on-one conversations and get your questions addressed. So it looks like there's a survey in the chat. So here's the deal with the surveys. If you click on that link, there's 2 questions. It'll take you like 20 seconds to fill it out. 1 means I hated it, I'm never coming back. 10 means I loved it, I'm not going to miss it again. And then there's everything in between. My commitment to you is that if you want to fill that out, and then you have the ability to put in comments. So if there are things you'd like to see in upcoming classes, let me know. I promise to read all of those comments and then pass them on to Cameron May. Our management team will look at those also. In addition, if you hit the like button, it not only, as Cameron May likes to say, sounds like applause to us as coaches, but it also moves it up in the algorithms on YouTube so more people will see this content. So if you could do that, if you thought this was worthwhile, we'd appreciate it. Yeah, and then don't forget to follow Mr. Ben Watson and I in the land of X. His handle, Ben Watson CS, Barb Armstrong CS for me. And you can now also find us both on LinkedIn. So head on over and find us there. When there is a survey, one thing I'm often asked is, what did you do today? So we decided to ring the bell. We took the money and ran on Cisco and Google, where we had 75 and 80% of our max gain on those 2 trades. We then sold a covered call on a current position on Intel. We did a buy right covered call on Intel, and we did a buy right covered call on TSM. So if I get to fill in again for this class, we'll follow up on these trades. It's been a pleasure being with you today. Tomorrow, I'm filling in for Cameron May again, and I'm teaching Getting Started with Options. So that's like a trip down nostalgia lane for me, because I was the first person to teach that class and taught it for many years. And then I'm also teaching Getting Started with technical analysis at 2:00 Eastern. So you can join me for that. Yeah, but stay tuned. Coming up at, the next class coming up will be trading ETFs with Rachel. That one you have to attend live because it will not be archived. So thanks to Ben for his help in the chat. Thanks to the guys behind the scenes for helping this class come to life. And thanks to each and every one of you for your insightful questions, your humor, and the great energy you brought to this class. So take care, everyone. Have an awesome day, and I'll see you tomorrow. Bye for now.